There are two kinds of life assurance policies. In red, you can see endowment policy. In green, you can see whole life policy. Let's discuss it further. First, whole life policy. A whole life policy runs for the whole life of the insured and premium is payable all along. The sum assured due for payment to the heirs of the insured only after his death. The company will pay the amount. Second one is endowment policy. An endowment policy, on the other hand, runs for limited period or up to a certain age of the insured. The sum assured becomes due for payment at the end of the specific period or on the death of insured if it occurs earlier. As you can see in picture, it is a description of fire insurance. A contract of fire insurance is a contract whereby the insurer, on payment of premium by the insured, undertakes to compensate the insured for the loss or damage suffered by reason of certain defined matter being damaged or destroyed by fire. First point is, it is the contract of indemnity, that is, the insured cannot claiming anything more than the value of property lost or damaged by the fire, or the amount of policy whichever is lesser. The value of property or lost or damaged by fire, or the amount of policy whichever is lesser or lower, is returned back by the company. Second point is, the claim for loss by fire is payable subject to two conditions. First is there must have been actual fire. Second is must be an actual identify accidental non-intentional fire. Third point is the basic principle applied with the regards to claim is the principle of indemnity. Fourth point is the insured is entitled to be compensated for the amount of loss suffered subject to the maximum amount for which he had taken the policy. As you can see in picture, it is in marine insurance. Marine insurance is an agreement by which insurance company, also known as underwriter, agrees to indemnify the owner of a ship or cargo against risks which are incidental to adventures. It also includes insurance of risk of loss of freight due on cargo. Second point is the owner of the ship may insure it against loss on account of perils of the sea. Third point is the ship is subject matter of insurance. It is also known as hull insurance. There are different kind of marine insurance. First is time policy. Second one is voyage policy. Third is mixed policy. And the fourth is floating policy. As we have discussed 4 of them before, now we will briefly define it one by one. The first one is time policy. This policy ensures the subject matter for a specified period of time, usually for 1 year, It is generally used for hull insurance or for cargo when small quantities are insured. The second one is voyage policy. This is intended for a particular voyage without any consideration for time. It is used mostly for cargo insurance. Mixed policy. Before we have read time policy and voyage policy, it is a mixture of both. Under this policy, the subject matter hull, for example, is insured on a particular voyage for a specific period of time. Thus, a ship may be insured for a voyage between Mumbai and Colombo for the period of 6 months under a mixed policy. Fourth policy is floating policy. Under this policy, a cargo policy may be taken for a round sum, and whenever some cargo is shipped, the insurance company declare its value, and the total value of the policy is reduced by that amount. As we have read fire policy, marine policy and life insurance policy, now we will discuss the difference between them. As you can see a picture over here, first on the basis of compensation, fire insurance, marine insurance, life insurance. In fire insurance, amount insured or actual loss, whichever is less is given, is compensated. In marine insurance, purchase price of goods and 10-15% of profit is given as compensation. In last, life insurance, no loss is compensable, only specific amount is paid. In marine insurance, purchase price of goods and 10-15% profit is given as compensation. In the last, life insurance, no loss is compensable, only specific amount is paid. Second, insurable interest. In fire insurance, insurable interest must exist both at the time of taking policy as well as the time of loss. Marine insurance, insurable interest must exist at the time of loss, and in the last, insurable interest must exist at the time of taking policy. Third point, assignment of policy. In first, fire insurance, no assignment without permission of insurance company. In marine insurance, no assignment without permission of insurance company. And at last, no assignment is done. Fourth point, nature of risk. In fire insurance, it is very uncertain. Similarly, in marine insurance, it is also uncertain. In last, life insurance, certain, but the time is uncertain. The fifth point, period. Fire insurance normally is for 1 year. Similarly, marine insurance is also for 1 year. But in last, life insurance, it is taken for long term. Sixth point is premium. In fire insurance, premium depends upon the amount insured. More the amount insured, more premium will be added. In second, marine insurance, premium depends upon the nature of policy. In last, life insurance, premium depends upon the age of insured and the term of policy. Seventh point is object. In fire insurance, to cover the risk of fire. In marine insurance, to cover the sea policy. In last, in life insurance, protection and investment. Eighth is surrender. In fire insurance, cannot be surrendered before the expiry. Similarly, as in marine insurance, cannot be surrender before the expiry. Similarly, in life insurance, cannot be surrendered before the maturity. There are different kinds of vehicles such as cars, vans, commercial vehicles, motorcycles, scooters, etc. Insurance of all type of motor vehicles cover the risk of damage of the vehicle by the accident or loss by theft. Also risk the liability arising out of injury or death. The next is Bulgari Insurance. Under this insurance, the insurance company undertake to indemnify the insured against losses from Bulgari, that is, loss of movable goods by robbery and breaking and theft by breaking the house. Next is Fidelity Insurance as the protection against the risk of loss on account of embezzlement or deflection of cash or misappropriation of goods by the employees. Businessmen may get policy issued covering the risk of loss on account of fraud and dishonesty on the part of employee handling cash or in charge of stores. Next is Personal Accident and Sickness Insurance. There are policies which can be taken out against death or disability in special circumstances. Next is Liability Insurance. There are two kinds of liability insurance. This type of policy covers the risk of liability for injury or death of someone. The first part is employer's liability. Covers the employer's legal liability for the safety of each employee. And the second one is public liability, which covers the liability of individual and business for members of public visiting the premises. Next is property insurance. Covers a wide variety of items from goods in transit or in store to building a consent. Principle of insurance. First is utmost good faith. Insurance contract are the contract of both mutual trust and confidence. Both the parties to the contract, that is the insurer and the insured, must disclose all the relevant information to each other. Second is insurable interest. It means financial or pecuniary interest in the subject matter of the insurance. It means that if there is a loss due to damage of the insured property to assured life, it will be personal loss of the insured. A person has insurable interest in the property person has insurable interest in the property of life insured with the stand of gain from its existence to lose financially from its damage or destruction. The word indemnity means to restore someone to the same position that he/she was in before the event concerned took place. This principle is applicable to fire and marine insurance. It is not applicable for life insurance. Because loss of life cannot be restored or compensate is paid on the basis of amount of actual loss or the sum of insured, whichever is lesser. Fourth is contribution. The same subject matter may be insured with more than one insurer. In such case, the insurer claim to be paid to insured must be shared or contributed by all the insurers in proportion to the amount of insurance of individual insurers. Fifth is subrogation. In the contract of insurance, subrogation means that after the insurer has compensated the insured, they will get the right of the insurer with regards to the subject matter of the insurance. Sixth is mitigation. In case of mishap, the insurer must take all the possible steps to reduce the mitigation, the loss damage to the subject matter of the insurance. The principal insurance that the insured does not become negligent about the safety of the subject matter after taking the insurance policy. The insured is expected to act in a manner as if subject matter has not been insured. Next point is causa proximia, nearest cause. According to this principle, the insured can claim compensation for a loss only if it is caused by the risk insured against. The risk insured should be nearest cause not only for the loss. Only then the insurance company is liable to pay compensation. For example, a ship carrying oranges was insured against the losses arising from the accident. The ship reaches the port safely and there was a delay in unloading the oranges from the ship. As the result, ship oranges got spoilt. The insurer did not pay any compensation for the loss because the proximate cause of loss was delay in unloading and not any accident during voyage. I hope you all have understand the chapter I have explained. Thank you so much. Namaste.